equity ETFs like XEQT are gaining quite the reputation for being the only ETF you'll ever need. It's time to find out if that is actually true. Fasten your seatbelts, folks. This is going to be a good one. XEQT is one of the more popular all-equity ETFs out there. An all-equity ETF is basically, as the name suggests, it is an ETF that contains a lot of stocks or equity without holding other financial entities such as bonds, commodities, or other non-stock asset types. This concentration in equities allows investors to gain a broad or targeted exposure to specific sectors, industries, or, of course, geographical regions. In the case of XEQT, we are more interested in that broad exposure to bring an all-in-one ETF that hits it out of the park when it comes to diversification. And it goes without saying, this level of diversification will also come with a lot less risk than investing in, let's say, traditional stocks. Also, there's a lot less management on your part. XEQT is the iShares Core Equity ETF, which is managed by BlackRock. Their portfolio is designed to provide investors with a comprehensive exposure to equity markets, primarily focusing on long-term capital growth. Since their inception, XEQT has been appealing to those investors who are looking for an all-equity, low-cost, and highly diversified portfolio solution. As we dive into the fundamentals in just a bit, we are going to see if they have delivered on this promise. Join today's conversation. Let me know in the comments if you hold any all-equity ETFs. Thank you for your participation. If you love this sort of content, be sure to hit that subscribe button for more. And another huge thank you for that click. ETF deep dives are a brand new feature on the channel. Yes, we have looked at ETFs before, but not in a full deep dive treatment. With that being said, the format and what we look at is going to evolve as your input only moves to strengthen what we are doing here. What are the arguments that XEQT is the only ETF you need to own? First, of course, is its comprehensive global equity exposure. XEQT spans across major markets, including Canada, the United States, and other international locations, and this is offering us a diversified mix of stocks from a wide array of sectors. This level of diversification can help mitigate risk while providing the potential for growth by capturing global economic trends. Secondly, its low-cost structure makes it an attractive option for cost-conscious investors aiming to, maximize their returns over time, without, of course, being eroded by all those high fees. Finally, the simplicity of managing a single ETF that encompasses a broad range of equity investments can appeal to both novice and experienced investors looking for an efficient way to build wealth over the long term. By consolidating what might otherwise require multiple funds or individual stocks into one ETF, XEQT offers a streamlined, effective investment solution that aligns with a wide range of investment strategies and goals. That sure does look fantastic, but as nice as that all sounds, we still need to check out the fundamentals. The numbers never lie, and thus we will once again call on our good old buddy, Mr. Math. As usual, we will begin with some surface data. So we have a current value at the time of recording of $28.77. They have an NAV of 28.77. Their net assets, they come in at $2.54 billion, and they have a very, very average beta of 1.00. And considering what this ETF does, I would be surprised if it ever fluctuates very far from 1.0. Their price to earnings ratio, it comes in at 16.58. Now, they've got a 30-day average volume of 160,576, so that's not too bad. Their return on equity looks good at 20.37%, and their return on assets, that comes in at 7.28%, so these both look pretty darn good. This data does look great, and you will find in general that ETFs will usually look good on the surface. So at this point, let's dive into some of those fund specifics. This fund has been around for a long time. In fact, their inception date is August 7th of 2019. Now, they do have fees associated. We got a management fee of 0.18%, and we've got a management expense ratio of 0.20%. A lot of people get a little confused with management fees versus a management expense ratio, or a MER. They are similar, and sometimes they may in fact appear to be the same. However, there is a subtle difference between the two. The management fee is a charge paid to the fund's management company for their services, so including their portfolio management, administrative work, and of course their operational activities. Now, the MER It's basically the management fee along with any additional costs of running the ETF, which could include things like, well, trading fees or even taxes, for example. Let's take a look at the holdings of this ETF. Let's see what we got underneath the hood here. Well, for XEQT, most of their holdings come in the form of other ETFs. And thus, well, we do have a top three. We've got the ITOT, which is the iShares Core S&P Total US Stock ETF. We have XEF, which is the iShares MSCE EAFE IMI Index. We also have the XIC, which is another iShares one, iShares S&P TSX Capped Composite. No worries, I'm not going to make you guys go and look at all of the components of these ETFs. You can if you want, for sure. But we're going to break those ETFs down to the company level, and the top three would then be, well, we got Microsoft at 2.91%, we have Apple at 2.58%, and we've got everyone's favorite lately, NVIDIA, at 1.67%. That's pretty cool. We also want to get a wee bit of a snapshot of their diversification, as this is supposed to be this ETF's main selling point. We will start with their sector breakdown, and those top 5 sectors, those do turn out to be technology at 19.63%, financials at 18.74%, industrials at 12.19%, consumer cyclical at 9.55%, and healthcare at 9.05%. Of course, another big part of their diversification is their geographical diversification. So let's take a look at the top 5 countries represented in their portfolio. Almost half of their portfolio is America, US stocks. They make up 46.29%. Canada comes in pretty strong at 23.39%. Then we got Japan at 5.97%. We've got the United Kingdom at 3.47%. And to top off their top 5, we got France at 2.54%. That does give us a good overall feeling for the ETF. They have a very solid company sector and geographical diversification, and that is great. So let's move on and peel back another layer and take a look at the returns. When it comes to dividends, they do have a smaller dividend. It's 2.009%, and that is a quarterly dividend paid out in the amount of 20 cents per share. Now, that dividend has increased over the last 5 years. In fact, their 5-year average dividend increase, that comes in at 11.06%. Let's take a look at the actual returns. When we switch over to the 3-year, their price rose from $24.32 to $28.77. That is a return of investment of 18.30%. And if we factor in the dividends, we do get a total return of 24.68%. On the 1 year, their price rose from $25.23 to $28.77. So that is a return on investment of 14.03%. It is a total return after we add in the dividends of 16.32%. So far this year, their year-to-date return on investment, it's pretty low. It's coming in at 3.98%. Total return is the same because we do not yet have any dividends from this ETF. It is good to see positive numbers, but how do they compare to the TSX? Well, for the TSX, the year-to-date comes in at 1.20%, their 1-year return comes in at 3.38%, and their 3-year return comes in at 15.30%. Let's also look at the S&P 500. So for the S&P 500, their year-to-date comes in at 4.51%, their 1-year comes in at 22.38%, and that 3-year comes in at 27.64%. Looking at these returns, they are okay, but they could be better. The ETF has outperformed the TSX on every time frame, which is fantastic. But what about that S&P 500? Unfortunately, they did fall short and underperformed in each of these time frames. I think we have enough data to get to that big question. What is my final verdict? XEQT is a great looking ETF, and it has more diversification than you could probably ever want. It is a fantastic way to gain a lot of exposure right across the boards. However, when it comes to that question, whether this is the only ETF you need to own, I'm not sold on that at all. It is a safe ETF, and I really doubt you can lose money investing in it. BlackRock is a solid company, so I don't have any worries of mismanagement or the ETF just closing up shop one day. They do call it a medium risk ETF on their website, but honestly, I do see it as relatively safe. So why do I think it is not the end-all be-all in ETFs? The performance is not up to snuff. For me, to be very happy with this stock, it does need to be outperforming both the TSX, which it does, and the S&P 500, which it does not. XEQT did not fall off the mark a great amount, but it did fail nonetheless. So that was the answer to if this is the only ETF you need. Should you consider this ETF as part of your diversification strategy? Completely different answer. It's yes. I think it is a good addition to your portfolio if you want exposure to the huge level of diversification that comes with it. It is a great buy and forget ETF that will fit into most investors' portfolios. Now, of course, the pure passive income investors are still going to want to pass on this ETF, as let's face it, the yield is not very exciting. If you are interested in the ETF that we looked at today, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey by checking out this video on technology ETFs. Thank you for watching, and I will see you in the next video.